Welcome to The Explainer. Today, we're going to break down a professional grade strategy for navigating those tricky market pullbacks. We're going to get right into a system that's all about aligning your trades with the big institutions instead of, fighting against them. Okay, let's just dive right in by looking at the biggest mental hurdle most traders face. On the left, you've got the classic retail playbook. You buy when everyone's excited and a stock is screaming higher, and then you totally panic when it pulls back. The strategy we're talking about today, it flips that script completely. It's about systematically buying when there's fear in the air and selling when everyone else is getting greedy. So here's how we're going to tackle this. First, we'll cover the core philosophy, which is all about trading against your gut feelings. Then we'll get into the actual homework, how to hunt for quality trends. After that, and this is crucial, we'll talk about waiting for the market's green light. And finally, we'll get into the nuts and bolts, buying with a solid plan and selling with discipline. All right, first up, we have to get our heads around the fundamental idea that makes this whole thing work. It's all about rewiring our natural emotional reactions to what the market is doing. So here's the bottom line. This system is literally designed to make you do the exact opposite of what your instincts are screaming at you to do. Instead of chasing a stock that's already gone vertical, you wait. You wait patiently for it to pull back to a key support level. That's the buying fear part. Then you hold it as it recovers, when things feel kind of comfortable again. And then you start selling pieces of it when it rockets higher and everyone else is jumping on board with excitement. Let's move on to the homework phase. This is where we build the foundation, filtering the entire market to find only the highest quality stocks. We're not looking for just any stock that's trending. We're trying to find the ones with real institutional footprints all over them. This first filtering step is all about making sure we're fishing in the right pond, where the big, long-term buyers are active. So we start with stocks on India's national stock exchange. Then we narrow it down to the big players, companies over 10,000 crore rupees in market cap, because those are the ones institutions can actually buy in size. And the real key here is the monthly super trend indicator. Think of it like a GPS for the long-term trend. We only want stocks that are in a confirmed uptrend and right now are pulling back close to that trend line. Okay, so from that filtered list, our job is to find the true leaders, not the fakers. We're looking for a nice, clean weekly chart that's making higher highs. We want to avoid stocks that have just gone vertical, because that can be a sign of exhaustion. And this is a big one. We want to see that the stock has bounced from its support levels before. That's proof. This process will naturally lead you to the strongest sectors in the market at the time. Now, we get to the part where discipline is everything. Patience. And I'm not exaggerating when I say this is probably the single most important part of the entire strategy. It's what really separates the pros from the amateurs. So think about it. You've done all the work. You've got your target, a top quality stock, pulling back perfectly to support. The setup looks beautiful. So is it time to pull the trigger and buy? Well, this strategy says not yet. And the reason why is what gives this whole system its power. The secret sauce is this. You wait for the broader market, the index itself, to give you the all clear. What you're looking for specifically is a pattern on the weekly chart where the index dips below a key level, but then it snaps back and closes the week strong. That's a huge signal. It suggests the big institutions are done with their buying and are ready to push the whole market higher. And this right here shows you why that patience is so critical. If you jump the gun and buy your stock before the market gives you that confirmation, you're basically just guessing. But if you wait for that signal, your odds of seeing a powerful move in your favor go up dramatically. It's such a simple step, but it completely shifts the probability game to your side. Okay, so you've gotten the green light from the market, time to execute. But even now, we're not just blindly jumping in with our whole position. Nope. The entry itself is a calculated, systematic process. What I love about this method is that it takes the pressure off of being perfect. You never have to buy your full position at one single price. Here's how it works. You put in your first 40% when the stock first touches that key support. Then you wait. If the stock bounces and proves that support is holding, you add another 40%. The last 20%, that's saved for when the stock actually breaks out, confirming that the next leg up has really started. And look, the goal of this strategy isn't to be a hero. It's not about catching the absolute perfect bottom or selling the absolute tippy top. The whole system is designed to capture that powerful, high-probability middle 60% of a major trend. We're happy to leave the most dangerous and unpredictable parts for everyone else to fight over. Okay, so how much money should you actually put in a trade? The rule here is incredibly simple. Stocks with stable, predictable trends, you can give them a larger allocation. But the more wild and volatile a stock is, what traders call high beta, the smaller your position size needs to be. It's that straightforward. This is such a powerful professional mindset. I really want this one to sink in. It doesn't matter how much you love a stock or how convinced you are that it's going to the moon. Your position size, your exposure, should be decided by its actual measurable volatility. Let the stock's behavior tell you how much risk to take, not your emotions. And when it comes to risk management, the rules are based on meaningful time frames. See, institutions don't freak out over a 5-minute price dip, and neither should we. An intraday drop below support, that's just noise. Ignore it. But a weekly close below that level, now that's a real signal. That means the trade is likely broken and it's time to get out. We're following institutions, not noisy candles. Finally, let's talk about managing the trade once you're in it, and just as important, how to get out. Because let's be honest, a great entry means nothing if you don't have a smart exit plan. And you'll see, the exit plan is just as systematic as the entry. It's built on that same core idea we started with: sell into excitement. So if you get a quick explosive rally of 10 or 20%, you take some profits off the table, thank you very much. As the trend starts to lose steam, you reduce your position more. And just like our risk management, the final exit signals come from a break of the weekly and ultimately the monthly trend. If all this feels like a lot to remember, let's just boil it down to one simple, powerful mantra that captures the entire process. Ready? Market confirms, then you buy support, you add on strength, and you exit on weakness. That's it. That's the whole game plan in one sentence. And that really leaves us with a final thought, doesn't it? We're all out there looking for some complex secret, some magical algorithm. But maybe, just maybe, the real edge isn't about complexity at all. Maybe it's just about having a clear, solid plan. And most importantly, having the disciplined patience to actually follow it.